Hello, this is Korey Matthews for Fin381. Tuesday, Thursday at 11 a.m. Dr. Cresson's classes, the extra credit assignment, the financial analysis of one company. Today I'm going to talk about General Mills, which is a food production company. We're also going to talk about short-term solvency, long-term solvency, and financial leverage, asset management, profitability, and market value ratios. Okay, let's start with the short-term solvency, or the company's ability to pay its bills in the short run. We'll start with the current ratio, which is also a measure of liquidity. The highest was at 0.07 and at 0.77 was low in 2015. You can see a decline here from 2011 to 2015, the last 5 years. Quick ratio and the current, you can see a slight difference here. As an indication that the company deals with inventory. So I want to take that also into consideration if I want to make them a short-term loan. And then the cash ratio, which is a low point of 0.07, which is not looking good in 2015, and the high point was at 0.17. This is a graph showing the decline in the liquidity ratios. You got your current at the top, you got your quick in the middle there, the yellow, and your cash in the orange. This is not looking good if I want to make a short-term loan to General Mills. They're having a decline in their current ratios, and they were below 1 in cash across the board in the last 5 years. 2011 was looking okay for their current ratio. If I want to make a short-term loan to them, it's not looking good. All right, next let's talk about long-term solvency. We start with the equity multiplier, which is the measure of leverage. It's also the use of debt to acquire additional assets. You can see it's steadily going up. Okay, that is something you want to take in consideration, especially when you're looking at your return on equity. I'll talk about that in a minute. The equity multiplier, you want that to be low. As you can see, it's actually rising. Times interest earned ratio, which is the ability to honor the company's debt. As you can see here, it increased from 2011 to 2014 and a slight decrease to 6.8 in 2015. This is a chart showing your long-term solvency, the equity multiplier in green here at the bottom, the slightly increasing, and your times interest earned ratio, which went up from 2011 to 2014 and then went down in 2015. So if I wanted to make a long-term loan to that company, I would take into consideration the fact that their ability to honor their debt, it's looking okay, but their use of debt to acquire additional assets is going up. So I would take that into consideration. I wanted to give them a long-term loan. All right, so next we're going to talk about asset management profitability and market value ratios. You can see your ROE here is steadily declining. That is not looking good because the risk is going up. And ROE, you can think of that as like the return that you're going to get back as a stockholder, and it's going down. So that does not look good if I wanted to invest in the company. ROA is how efficient management is when using assets to generate revenue. As you can see, it's declining from 2011 to 2015, from 9.89 to 5.41. Profit margins is how much money is being put back into the company. As you can see, this is declining as well from 2011 to 2015. Total asset turnover, which is also, it determines asset efficiency or measure of efficiency. As you can see, that is also declining, so that does not look good. And your P&E is how the market views the company. You want that to be high. That's a 6.93, which is not totally bad. But as you can see, ROE is steadily declining. And if we go back when we talked about equity multiplier, your risk is going up and you're getting a lesser return for more risk, so that's not good. ROA declining, profit margin declining, and total asset turnover is declining, so that's not looking good for investing in the company. This determines my financial analysis for 381 extra credit. This is Korey Matthews, and thank you. Have a good day.